Hey everyone, welcome back to Corporate Decoder, where we break down the financial secrets of the corporate world. And today, with Winmark Corporation, we're going to see just how much their resale business is really worth. Get ready because we're about to dive into a report that shows a company doing pretty well, but with some interesting financial details hidden in the numbers, especially when it comes to their debt and their stock. So let's jump right into the balance sheet, which is like a snapshot of what the company owns and owes at a specific moment. As of June 28, 25, Winmark had about $32 million in current assets, things like cash and money owed to them, which is a decent amount. But when we look at their long-term liabilities, that's where things get interesting. They have over $73 million in long-term debt, and that's a significant chunk of money, especially when compared to their equity. In fact, their total shareholders' equity is a negative $36.8 million. This means that on paper, if the company were to sell off everything it owns, it wouldn't have enough to pay back all its debts and obligations to its shareholders. This shareholders' deficit is a red flag that we'll need to keep an eye on. Now let's move over the income statement, which tells us how much money the company made and spent over a period. For the 3 months ended June 28, 2025, Winmark brought in about $20.4 million in revenue. That's pretty similar to what they made in the same period last year. Most of this revenue, about $18.7 million, comes from royalties. This means they're earning money from their franchisees, basically the stores that use their brand names like Plato's Closet and Once Upon a Child. It's great to see that their core franchising business is healthy, with royalties growing by about 5% year over year. However, their selling, general and administrative expenses, which are the costs of running the business, also went up. They spent about $6.6 million in the quarter, which is more than last year, mainly due to higher technology and employee costs. Looking at the statement of shareholders' equity, we can see how the company's net worth changes over time. It's important to note the dividends they paid out. In this period, they paid out over $6.5 million in dividends. While it's good for shareholders to get paid, when you have a negative shareholders' equity, paying out a lot of cash can be a risky move. Now for the cash flow statement. This shows us the actual cash coming in and going out. For the first 6 months of 2025, Winmark generated over $24 million in cash from its operations. That's a good sign. But then you see they used over $2.4 million to buy back their own stock. This, along with the significant dividends they paid, suggests they are returning a lot of cash to shareholders. Let's talk about their debt more. They have a $20 million line of credit and $30 million in term loans. Luckily, they weren't using their revolving credit as of June 2025, meaning they had that full $20 million available if they needed it. They also have notes payable of nearly $30 million related to their agreement with Prudential. One interesting point is the compensation expense related to stock options. They expensed over $1 million in the first half of 2025 for stock options. This is a common way for companies to incentivize employees, but it does eat into profits. Across the board, revenue from their franchising business is growing. For the 6-month period, total revenue was over $42 million, up from about $40 million last year. Their operating expenses are also climbing, with selling, general and administrative costs up about 7.4%. This is driven by things like technology costs and some non-recurring software licenses for their franchisees. Their leasing business, which they're winding down, brought in some extra cash this period due to a lawsuit settlement that amounted to over $2 million. Without that, the leasing income and expenses would be much lower as planned. Looking at their franchises themselves, Plato's Closet, which is their largest brand, now has 526 locations. They opened 13 new stores and only closed 2, which is fantastic growth. Across all their brands, they now have 1,371 stores open, with 13 more opening in the first half of the year than closing. This expansion is the engine driving their royalty income. And what about the health of their existing franchises? Management really focuses on keeping franchisees happy and renewing their agreements. Out of 61 agreements that were up for renewal, they renewed 60 of them, which is a really high renewal rate of 98%. This strong renewal rate is a good indicator that their franchisees are doing well and see value in staying with Winmark. Their strategy seems to be focused on supporting their franchisees to increase revenue, opening more stores, and controlling their operating costs. When we look ahead to their liquidity and capital resources, they ended the period with about $28.9 million in cash, which is slightly less than last year. However, they have access to a $20 million line of credit that wasn't being used, which gives them a safety net. Now on to the big picture, Winmark's overall direction. They are clearly focused on growing their franchising business, which is generating solid royalty income. The expansion of their store network is a testament to the strength of their brands. However, that negative shareholders' equity and significant debt are considerable risks. While they are generating enough cash from operations to cover their obligations and pay dividends, that negative equity means they have more liabilities than assets. This can make it harder to get more loans or could make investors nervous. The company seems to believe they have enough cash and access to credit to keep operating smoothly, but any economic downturn could really put pressure on them, especially with their debt load. They are effectively managing their core franchise business, as shown by the store growth and high renewal rates. But the overall financial structure, with that deficit in shareholders' equity and substantial debt, means they need to keep generating strong operating cash flows. Otherwise, they could find themselves in a tight spot. What's your take on Winmark's financial health and their growth strategy? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth financial analysis. Also, join our Discord community linked in the description for even more exclusive content and discussions. Thanks for watching, and I'll see you in the next one.